is correct, this is correct, this is correct, this is correct. So we can copy this across. And then our receipts minus our payments, we can copy that across. This is the calculation. And now you can see we're under 40,000. So we could do the calculation this, and we need to bring that up to 40,000. So we could say we need to bring this to 40,000 because that's the minimum that this note says we want to be at. And we could then do the subtraction, 40 minus the 23. So the plug will be the 40 minus the 23 means we had to borrow 16,752 to bring us up to that minimum balance because we want to have a cushion of the 40. So if we think about that short-term loan balance schedule, then we can think about it. We're starting off with the 12 here, and then we paid it off this month, so we have nothing in there, and we can sum it up. And then of course we had no loan balance here. And then in this month we started with 0, but then we had to borrow this 16,752. So that's our loan balance now. So now we can take a look at the sales budget, the income statement. So we can take a look at the income statement. So the income statement being sales, which is going to equal, and the sales up here we have the 1,431,000, enter. Then we're going to calculate the cost. That will equal, I'm going to scroll up to the units we produced, 60,000 are the units that we're going to sell, and the cost per unit of production according to A here is 19.85. So times 19.85, and there we have that. Then our gross profit, the most important relationship is the sales minus the cost of goods that we sell, gives us our 240. Then we can take a look at our sales commission. So we have the sales commission on a cash basis. It's going to be the same for an accrual basis in this case. So the sales commissions are up here. I'm going to have to sum up the quarter. So I'm going to say this equals the sum of the sales commission here for the quarter. That gives us the 114.4. We're going to do the same for the sales salary, the sum of, in this case, the 3,000 for the sales salary. And that gives us the 9 in this case, same for the general. So the sum of the 12 gives us the 36. And then the long term is going to be this item. So we can sum that across. And then we got the interest, and we calculated the interest to be just this 120. Again, we could sum it. We probably should conform and sum it across, even though there's zeros. I missed the equal sign. Equals the sum of the 120 is all we had for the quarter. And then if we sum up the total operating expenses, equals the sum of the total operating expenses here. We have that, and then we're going to calculate the net income, which is going to equal the gross profit minus the total operating expenses. Then we're going to calculate the taxes. They're going to have to give us a tax rate, and it's 35%. So we're going to say there's the 66.9 before Uncle Sam, and then Uncle Sam's going to take 35%, 0.35. Therefore, after that, we're going to have net income of the 43,485. All right, let's take a look at the balance sheet now. So we're going to scroll down to the balance sheet, and we're going to start off with cash. And we calculated cash in our cash budget. So we're going to say this equals, and we're going to scroll up to that 40,000 here, and that's the ending balance. Now, don't get that confused with the beginning balance, which also happened to be 40. It just happens to be 40 because we needed to bring it up to that minimum balance. Then we're going to calculate the receivable. So in order to calculate the receivable, let's bring our cursor over to this worksheet on the side here, and we're going to start off with the beginning receivable, which was the 342,248, 342,248, and then we had the credit sale. So we'll calculate this taking total sales. So I'm going to say equals and scroll up to the sales that we had up here for the month, and that's the 1,431,000, and then remember that we had 70% on credit. So therefore the credit sales, we had this times this, and that gives us our 1,001,700. And then we could take our cash collections from the credit sales, which we could just scroll up here and look at this item here being total cash receipts, cash budget, and then we have sales on credit. Collections of receivables are going to be here. So on line 71, if we sum those up, then we can add all these up. This, well, we can say it's the beginning receivables plus the sales minus what we received, what we collected on. That will give us our receivables as of the end. And that's going to equal then this number. All right, and then we're going to take a look at our raw materials. Once again, we'll calculate that over here. So we're going to say the raw materials down here. We have the ending raw materials. I'm going to look at my raw materials up here and say, where's my ending raw materials? If we go back up to the raw materials activity, in the ending units, we have 4,000 units. So I can say there's our ending units. And we said that those over here cost $20 a unit. Therefore, I'm going to multiply that times 20. And that should give us then equals the 4,000 times 20 a unit, the 80,000. So we can scroll over here. The raw materials then will be this 80,000. All right, and then we've got the finished goods. So we're going to take a look at the finished goods calculation over here. And we're going to start with the beginning finished goods, which is going to come from our financial statement, which will be this 325,540. Then we're going to add to that the cost of goods completed. And I'm going to take that actually from the cost of goods sold, because the cost of goods completed and sold, we completed and sold the same amount. So we're going to do this calculation to show how the calculation would be, but cost of goods completed and sold were the same. Therefore, we're saying it's the 325 plus minus this. We remain at, in this case, the 325,540, and that's going to be the finished goods inventory. So that gives us this number. Then we can sum these up. So the total assets then will be the sum of these. Then we have the equipment. So the equipment, we said we purchased another. So we started out with equipment of 600. And then we purchased equipment of our cash, the 130. And that'll bring us up to the 205. So the accumulated depreciation is going to equal the prior year's accumulated depreciation of, in this case, 150,000 plus the current period's depreciation of 60,000. This should have another zero for the 210. Now I'm going to make that negative because I think Connect wants it to see it as a negative by putting a negative in front of it and flipping the sign, so that we can then sum them up by saying it's this positive number plus that negative number. That'll give us the total assets, which are the sum of this and this. And then we're taking a look at the liabilities. So first of all, on the liabilities, we're going to have to look at the accounts payable, but we'll do a similar calculation as we did for the receivables. And we're going to start with the beginning liability, which is the 200, in this case, 205 right there. And then we have purchases of raw materials. So that equals, I'm going to go over to our purchases up here. Raw materials were purchased for the quarter of the 581.5. And then we have the payments for raw materials. And we're going to say that equals the sum. And we're going to go to our cash payments area. So our cash budget. And we're looking at the payments for raw materials here are going to be the sum of these. Remember, they were a month off from the purchases because we paid them all in the prior month, 100% payments in the following month. So therefore, the accounts payable is going to be the beginning balance plus what we purchased minus what we paid to give us this 182 in this case. So this number will be the 182. All right, and then we have the bank loan. So we're talking the bank loan after the 182 is, so no change to the bank loan. It's still on the books at this 208,788. So that's 208,788. No change, and we just paid interest on it. The income tax payable is going to equal the income tax from our income statement, this amount here that we just came up with on the income statement. So then we're going to have our current liabilities summing up these three. Then we have the long-term notes payable. Once again, that will remain the same. So the long-term note on the balance sheet here was 500. So we got the 500,000 stockholders' equity. We didn't issue any more stock, or buy any of our stock. So the stockholders' equity, the common stock, will remain at the 335. So 335. And then the retained earnings is we'll do a quick calculation on the retained earnings. We're going to start with beginning retained earnings, which is 208,788. Then we're going to add to it net income. Net income coming from the income statement of 43,485. And then we're going to subtract from it dividends, 10,000. That we see it in this item down here saying we have dividends of 10,000. Therefore, retained earnings at the end will be this 242. So the dividends are going to, the retained earnings at the end will be the 242,273, and therefore the total equity is going to be the sum of these two, and the liabilities and equity then are going to be the sum of these, and hopefully we're in balance, and we're not. Let's see what. Okay, somehow I lost track of the bank loan up here, so I'm going to delete this bank loan up here. The bank loan is actually, this is the short-term bank loan, is going to equal what we put in our cash budget, this item at the end here, and there, that should do it. That'll put us in balance there. So that's the end of the balance sheet.